Good morning. Morning. Actually, it's afternoon. So, today we're going to be going through, I'm going to be touching on weekly profile, and generally how to, um, high probability reversal points and, targeting liquidity. So, we are on the pound versus the dollar. So, it's GBPUSD by ticker symbol. And, we can see that we've had higher prices. Now, today is Wednesday. I'm just going to mark out my charts. Today is Wednesday. Yesterday was Tuesday. And generally, so there are going to be about 3, 4 things I'm going to point out in this video. And the first thing being that with my back testing, with what I've seen, with forex pairs, especially the pound dollar and the euro dollar, but especially the pound dollar, the low of the week or the high of the week usually tends to form on early on in the week. So you have the low or the high of the week from either on Wednesday or Tuesday. It's either Wednesday or Tuesday. Ideally, I like Tuesday. Tuesdays are very, if I see it on Tuesday, I'm going to favor Tuesday and I'll be looking for Wednesday to run up into resting liquidity. Now, straight away, we can see Monday. So Monday starts about here. So what will happen is that one, I'm just going to type this out. The first thing you want to see is you want to see Monday trade lower. So you want to see Monday trade lower. If you're expecting higher prices, now this is if you're expecting higher prices. You want to see Monday trade lower. And going into Tuesday, you want to see a manipulation leg down. And this manipulation leg down should happen at a key time of day. And then you want to see this manipulation leg down take out a swing low. Okay, so these 4 things, you're looking for these 4 when you're bullish on the higher time frame. So generally, if you move to the daily time frame, we're looking for higher prices because why? We've seen lower prices throughout the month of June. We've traded into a daily imbalance. So right there, we've traded into our daily imbalance. That's a fair value gap, a BC, a buy side imbalance, sell side inefficiency. We see price trade down in there. You can see how price is respecting the midpoint of the fair value gap. That's the signature in price that lets us know that price is not willing to go below that. We've priced in the discount and we are now we're looking to trade higher. So with that being said, if you drop back down to the hourly time frame, you can see on Monday price starts trading down. Remember what we said we want to see ultimately. Hang on, where is right there? So ultimately we want to see Monday trade lower. We want to see lower prices on Monday. Then when Tuesday opens up, so right there, when Tuesday opens up. So when Tuesday opens up at a key time of day, and what is this key time of day? The key time of day you're looking for is 2 a.m. to 4 a.m. New York time. That's your time, that's your operating window, that's your hours of operation. That's when you're looking for the setup, the manipulation leg down. So now we can see that this is the consequent encroachment, the midpoint of the daily imbalance. See how price trades right down to it right there and reverses on the time. But we'll drop down into a lower time frame and note these lows note this low that's just above the midpoints. So that is what we would call sell side liquidity. Why? Because they are willing buyers, people that bought all the way down there to ride it to this high. They are being rug pulled. Their stop loss will probably be below that, and that's why you see price purge down, take them out of their trade. So if you're in a buy position, how do you come out of a buy position? You have to sell what you've bought. And once you sell, guess who's wanting to buy at this level? Smart money, hence the reaction this way. That's literally what's going on. We drop down to the 15-minute time frame. 10 minute, we can see now it looks clearer now. It looks much more clearer. So now we have sell side taken. We have midpoint of the consequent encroachment of the daily gap, that daily gap on the right, that straight candle up, the midpoint of that, the fair value gap. See price straight down into that. At what time of the day? Look at the time axis. So that was at 3:15. So we are looking at from 2 a.m. to 4 a.m. So from 2 a.m. right there to 4 a.m. That's when we're expecting the manipulation to happen, and exactly at that time it trades down. This is a Judas swing. It's fake. It's not real. It's there to trick you. It's like, think of think of think of when you're playing football and you have like a body feint. The body feint, the player with the ball goes in feints his body in one direction. So you also follow that direction and then he goes in the other direction. That body feint, that's this straight leg down. This one, two, three, four, five down close candles just pouring down to take out this liquidity. Once you see this, that's your go ahead. You've seen that. You've seen Monday trade lower. You've seen the manipulation down on Tuesday at a key time of day between 2 a.m. to 4 a.m. New York time, and you've seen it take out a swing low. See how the swing low is there? It's just on its own. You can't miss it. It's just there standing. Just obvious liquidity resting. Once you have all these four boxes ticked, now that is your go ahead to start looking for buys. Now you're in a buy program. You're looking for buys. You're looking for higher prices. So as you can see, you actually see me execute on this. I'm just gonna show my. So this was yesterday. I actually opened up a position right there. So you see me. So any kind of retracement down. So once this happens, any kind of down close candle, I'm looking to buy that. Any kind of down close candle, you're looking to buy that. So you have a fair value gap, an inversion fair value gap over here. The moment price traded down into that inversion fair value gap, I'm just gonna dim this a bit so you can see the contrast. So the moment price traded down into this inversion fair value gap. So an inversion fair value gap is a fair value gap that's in the opposite direction to the price you're expecting. So if we are bullish, we're looking for price to trade down into a bullish fair value gap like this one to continue. But an inversion fair value gap would be a down close fair value gap. The price trades above, violates, and then returns back to it as real support. This is the real support in the market. So once that happens, I use that to go long, stop loss below the old candle, because when you're bullish, down close candles should support price. When you're bullish, down close candles should support price going higher. And you can see that once the manipulation happens, the move is very sustained. It's a really nice move to take part in. It's a really nice value to take part in. My take profit is above this high because that's another obvious level of liquidity resting. I plan to hold this trade for the rest of the week, but with the high impact news coming up at 10, it's currently 7:55 New York time. So high impact news at 10, high impact news at 2 o'clock, and ultimately on Thursday at 5 a.m. we have the general election. So obviously now a lot of people feel that news cannot be predicted. But having seen this logic I've outlined here, having seen all of this, you can clearly see where they're going to drive price next. You can clearly see what the news is going to do before time. You can see what they are trying to target. It's very obvious. It's this high right there. And you take it and you close your trade and you be happy and you move to the sideline, because I don't know how far it could go up. I don't know. It could go up there. It could go all the way up there. I really don't know. But the lowest hanging fruit, the one that is within reach, the shortest one, taking out Monday's low to target Monday's high. Right there. Simple. It's not complicated. You take your bit and you move on. Now, if you look at this trade, you don't need this kind of trade to be profitable. So you're risking one. So that's where my stop loss was. This is a 13-hour trade. So if you're risking $1,000, you're going to get 13,000. You're risking 5,000, you're going to get about 80 grand or so. So that is the general outline. So you're looking for a manipulation down, if remember the premise is that you're expecting higher prices on the higher time frame. So on the daily, you're expecting higher prices. You drop down to the hourly to the 15 minutes. Now on Tuesday or Wednesday, you're looking for a manipulation down and a rejection of that. Once that happens, any kind of retracement down, you can buy that as long as you're within the kill zone. Once you've traded down, your stop loss should be maybe below here, or you can put your stop right down there at that low if you're not feeling up to it. If you're not trying to get stopped out prematurely, you can put your stop loss below there, right there, and ride it to the very top. So not this won't work every time. That's why you have a stop loss. That's why you manage risk. That's why you don't risk your whole capital. So that is literally it. That is something I've found out. I've been investigating on the pound dollar for a long time now, and I'm decided to share this, to put this out there, because it's very empowering knowing something like this, and you can see that same similar setup happening again. Remember, 2 a.m. to 4 a.m. Now that's Tuesday. Now Wednesday, we see a manipulation. Now what time? What time of day is this? 2 a.m. At exactly 2 a.m., price trades down, takes out sell side liquidity, takes out sell side. All this, we are below the midnight open. Below the midnight open. So that's the opening price at midnight New York time. And if you're bullish, you want to be a buyer below the midnight open. Same thing here. This is the opening price at midnight. Right there. That's the opening price at midnight. That's our midnight open. So if you're bullish, the best buying opportunities, you want to buy below the midnight open, because the daily candle will look something like this. The candle opens, rallies down, makes this Judas swing, tricks people in, and then expands back up to form the range of the day, and it then closes back down to form the close. So the general premise is open, low, high, close. Then you have a candlestick that looks something like this right there. So that will be the manipulation leg down. So this is your daily candle. Once price opens, this is your midnight open. This is your opening price at midnight. That's your midnight open, which I've delineated here, right there. This midnight open. The opening price, when the trading day starts, it opens there. It rallies down, makes the low of the day in London session on a day that is high probability for the low to form, which is Tuesday or Wednesday, and then the expansion for the week, for the day or for the week, and then makes the high, and then to close near the high. So that's basically the outline. That's basically it. If you can understand this, study this, look at your own chart and study this, it's going to be very, very, very beneficial. It's going to provide you with a lot of clarity. Now imagine if you try to sell this, you actually fell for this and you tried to sell it, and maybe your stop loss was above this high, and you see that price is heading to your stop loss, and you try to move your stop loss up. Oh, it's gonna reverse, it's gonna reverse, it's gonna reverse, it's gonna come back down. I'm sorry, it's not gonna come back down. And these are the days where you would blow your account. You would actually blow your account on these days, because you'll be adding more sales thinking it's going to drop down, and it's just ripping higher and ripping higher and ripping higher, because there is resting liquidity above there. That's where liquidity is, and price will gravitate towards these levels. So that's just something for you to know, something for you to observe, study it in your charts, look at it, and depending on what assets you trade. Now this is on the pound dollar, but this works on other currency pairs as well. But it's up to you to study them, back test it, look at it in your own charts, make notes. It might be that the low of the week tends to form on Wednesday for a different pair. It might be the low of the week tends to form on Thursday for a different pair. I don't know, but for the pound dollar, for GBPUSD, I've found that the low of the week tends to form on Tuesdays or Wednesdays. Those are high probability days for the low of the week to form. In my own experience backtesting, in my free time, what I've found to be true for me, what I've found to trust, that's what I've come to realize. So it's up to you to go back to your charts, investigate, analyze, take down notes on what you see happening in the chart, and that will guide you to trust this. And hopefully you found this insightful, and I'll talk to you next time. Peace.